Hi, we are Group 8 and we are going to be presenting on high performance tire. Our group members include Ramandeep Singh, Karan Kumar Yadav, Dwayne Jude Saldana, Keshav Minas, and Aldia Stephen. This is the table of contents. We'll be going through a brief introduction, quantitative and qualitative analysis on profitability, liquidity, asset management, long-term debt, as well as alternative analysis and recommendations. So for the introduction, we'll look into High Performance Tire Limited's financial health using ratios. We'll check if the company can handle its bills now, how much it relies on borrowed money, how well it turns assets into sales, and how efficiently it operates. The ratios help us suggest quick fixes and long-term plans for HPT's challenges. It's like a financial health check that guides us on what needs attention. So the classification of ratios. The slide breaks down High Performance Tire Limited's financial health into key categories, which is profitability, liquidity, turnover, and long-term debt. So here we take a look at HPT's earnings using the gross profit ratio, which shows us how much money stays after covering production costs. The data raises a big red flag. Profits took a hit since William Wallace took charge. Even though the basic profit margin stayed steady, this could be due to changes in pricing or operational costs. A lower ratio hints at problems in how the company buys and sells, while a higher ratio is usually good news. Keshav will take over with the rest of the presentation.
Hello, myself Keshav. So I'll be represent the operating margins. The operating margin represents how efficiently a company is able to generate their profit through its core operations. Higher the ratio are the generally better for the illustration of the company, and it is efficient for the operation, and it's good at turning the sales into profits. As we can intercept from this case study that the operating margins of this company has significantly on a decrease from the year 2001, 2002, and 2003. So this decline highlights the potential challenge in maintaining profitability at the operational level, and the closer examination of cost structure and operational efficiency to identify and address the underlying issues. So it's basically the formula of the operating profit ratio is operating profit divided by sales into 100. Can I go to the next slide? Yeah. So for the next step, we are looking for the current ratio. The current ratio compares all the company's current assets to its current liabilities. This ratio measures a financial strength of the company, and generally that ratio is 2:1 and is treated as the ideal ratio. And we can also see the current ratio of this company is also is on the decreasing stage from the year 2001 to 2003, and the interpretation is that the drop in this current ratio from the year 2001 to 2003 shows that the company might have trouble paying its short-term bills with the money it has right now. We can calculate the current ratio by the current ratio divided by the current liabilities. So from here, I will hand over the PPT to the Ramandeep Singh.
Now I will talk about the cash ratio. Basically the cash ratio measurement the company's liquidity. Over here we can see like from 2001 till 2003 it has decreased significantly from 0.38 to 0.16, then 0.04 in 2003, whereas the average industry ratio should be 0.51. Now we will move to the next slide, which is fixed asset turnover ratio. Here it states that it has been decreasing significantly from 2001 till 2003 again, from 2.56 to 1.93 in 2002, Then again in 2003 to 1.34. Basically, the industry average should be 3.19, but it isn't like same as the industry average. Now we will move to the next slide. Now we will talk about the total asset turnover ratio, which signifies that it's like how a company uses its asset to produce the sales. So in 2001, it was 1.72. Now in 2002, it is 1.46. And in 2003, it is 1.07, whereas the industry average should be 2. So it also shows that it has decreased significantly and the company has not been able to generate sales from the assets. Now I will hand over this PPT to Karan.
Thank you, Ramandeep. So talking about the debt ratio, it basically measures the company's growth through its acquired assets over time, and it is generally calculated by debt upon the assets. And if we talk about the interpretation for high performance tires debt ratio, it decreases from 17.64 in 2001 to 53. It increases in 2001 and then gradually increases till 2003 till 53.34, showing that the company took on a lot of debts and which may be possibility to support the William Wallace expansion plan and to improve upon the company's financial health and match the industry standards as well. For example, paying some of its debts. Moving on to time interest earned ratio. So time interest ratio is sometimes called as the interest, like earnings before interest and taxes, and it is generally calculated by dividing the interest before interest and taxes upon the interest. So we can see a gradual decrease in the times interest earned ratio by 8.87 till 1.08, which is a major decrease as compared to the industry standards of 14.63. And as a part of the turnaround strategy, addressing and improving these ratios is very crucial for an organization to enhance the financial stability and to align with the company's performance with the industry benchmarks. Now I will hand over this presentation to Aldia Stephen.
Alternative analysis. High performing tire HTP Limited faces challenges and opportunities in a dynamic environment. Key alternatives include recognizing market entry barriers as a productive measure, acknowledging customer bargaining power, maintaining a delicate balance with suppliers, addressing competition from alternative options like loop stores, and strategizing against strong rivals such as Canadian Tire. To navigate these complexities, SWOT analysis is crucial. It enables HTP to leverage strength, addresses weaknesses, capitalize on opportunities, and fortify against threats. Next slide. Recommendations, strategic reorganization. It focuses on high demand services and evaluates the performance of each outlet. Second is resource allocation for customer service. This addresses past issues, builds trust, and ensures customer satisfaction. Third is optimizing workforce. It reviews and adjusts the pay structure to recognize achievements. Fourth is cost control and operational efficiency. This uses just-in-time inventory management and assesses cost for future expansion. The fifth point is business restructuring. This evaluates and potentially closes underperforming outlets. Sixth is membership loyalty program. It introduces a tiered membership program to boost customer retention. And the last point is implementation and reviews. Here it periodically reviews and adjusts strategies for long-term sustainability. Thank you.